Gold's now saying, I'm gonna beat the S&P. I'm gonna head into a trend. Given the size of this base, 10 to 11 years wide, and the depth of it, you're not going up for a month or two. You're gonna go up for a couple of years. Silver's been stuck in a half a century range. Why? We think silver's gonna do something extremely dramatic, and it's gonna do it in the next handful of months. Probably see $200 by the second quarter. Now, I could be wrong. We might vastly overshoot and see something even higher than that.
Michael Oliver, founder of Momentum Structural Analysis, it is a true pleasure to host you back on Palisades Gold Radio today.
Thank you, Stijn. Good to be back.
Michael, it is a phenomenal time to have a catch-up chat with you. Gold is very close to again flirting with all-time highs. Silver seems to be strapped on a rocket. It's up over 120%, or sorry, very close to 120% year to date. Perhaps we should start with gold. Where is it currently standing, and what is your short to medium-term outlook?
Yeah, the mama market of the monetary metals. And so far, over the last 5 decades, it's been a leader, okay, in terms of dimension of gain since 75, when it was 100, and 76, it had a corrective low at 100. Start from there, we're 4,400, okay? You do the math. But something big just happened in November. And it wasn't up in gold or up in silver. Yeah, that happened. But that's been going on for a while. Gold's been in a bull market for a while. But something new happened. And that is that an asset class shift was signaled. Meaning, the chart on page 4 of my weekend report, if you can pop that one up, it shows what we call a spread relationship between gold and the S&P 500, meaning at the end of every month we plot where's the front month contract of gold divided into the S&P, express that as a percent. Okay. And we know in 2011 gold peaked, and in 2013 it particularly started to collapse toward the 2015 price low. And in that process, its performance relative to the S&P was also dropping. Okay. And so the top chart on page 4 shows that spread collapse, where we were dropping from like 80% gold versus the S&P to down to close to 50 at the end of 2015, which is when gold actually made its price low. But then since that 2014-15 period there, where it dropped down near 50% of the price of the S&P, you could draw a line sideways if you want to. And we've been oscillating either side of that. But actually there's been a slight gradual downtrend line on the spread chart. A technical feature, okay? And you can see 1, 2, 3, 4 rallies. Back in April, we hit that line again and dropped back, April, May, June. And then in November, last month's close, gold closed on a spread basis, relative performance, out above that structure, meaning I'm breaking out. Okay, now, this is a beginning sign. This is not what happens late in a trend. This is saying, hey, you think you've seen a bull trend to date? It's just beginning, because the asset class shift is commencing now. It's no longer a duel between gold and the S&P, which basically has been sort of oscillating sideways for 10 years, where whether you bought gold or S&P, it did about as well. Okay, gold's now saying, I'm gonna beat the S&P. I'm gonna head into a trend. But given the size of this base, 10 to 11 years wide, and the depth of it, you're not going up for a month or two on this performance. You're going to go up for a couple of years probably. But it just broke out. So that the people that think, hey, gold's been going up too long, it's got to go down some, got to correct. This technical indicator here says, no, it just began. And then when we plot gold versus the NASDAQ 100, which is, the AI stocks, it's also breaking out. So gold's breaking, and versus the Dow and the New York Composite, gold already broke out months ago. So what it's saying is, if you're going to invest in an asset category, which one, stock market or gold? It says, start now, gold. The game just started. Anyway, very informative charts, I think.
Definitely incredibly informative. Michael, historically speaking, how predictive has this ratio between gold and S&P 500 been in this way?
Yeah, spread charts are very predictive, not just whether they go up and down. And any chart oscillates, up and down. The price charts, that doesn't mean anything. So gold's had some surges in the last 10 years. You can see them on the spread chart. They go up to that green line and fail. But this is a breakout. Now, whenever we find breakouts on spreads, and what we like about spreads in particular is most people don't look at them. Most people just look at a gold chart or an S&P chart and say, oh boy, look, it made a new high, whatever. It's the relationship between the two that says money flow is now going to go more into gold than the S&P. And as the S&P wobbles around some more, and it's gone nowhere for 3 months, and it's only like 10% or 11% higher than it was beginning of late last year's close. Whereas gold's up enormous percent since last year's close. But the spread is informing you this is a technical shift of sizable quality. And you don't get them that often. I mean, you get ups and downs all the time, but you don't get a structural breakout like this that's so clear that even a 5-year-old kid with a crayon on a ruler could plot it. It's in your face, okay? So, but again, the virtue of this, and we do spread analysis quite often in addition to our momentum structural analysis. But spreads are not a common tool. And that's good because that means not everybody knows about it.
Yeah, well understood. And you're kind of plotting a capital rotation into from the SP 500 into gold. How far can the spread actually go?
If you just want to take the dimension of that base there and treat it like a regular price chart, you got a line up there at 60% you broke through, and you got lows under 40, so you could go. We're going up to 80% of the value of the S&P, but that's not necessarily the case. That's just a simple minimum swing objective, but it's broken out, it's fresh, and it's massive, so it's not a trivial signal. And it's also a beginning signal. So those who think that the monetary metals have had their party, it's just begun. Because when that stock market continues to fiddle around like it's been doing, in other words, not really making money, or if it rolls over, as we argue it's going to early next year, and then people get shaken up, even more money will begin to flow out of the stock market category into that which is working. And already some asset managers, it's clear by this chart, have realized gold is working, okay? And they're moving already. Anyway, that's a very important chart to keep in your mind.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Gold Corp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Well understood. And Michael, it seems that this year silver has taken the leadership in this bull market for precious metals. It's up over 120% or very close to it. Gold is up around 66%. Have we now entered into the next stage of this bull market?
Yeah, now silver relationship to gold is also been subdued, like this chart here, especially since 2020. Remember, both metals had a big surge in 2020 from early that year through later that year. Silver like doubled in price from 15 to 30 and gold went up 40%. So silver beat gold on a percent basis. But since 2020, silver's performance to gold has languished. It's pulled back. So have the miners versus gold. Now that doesn't mean they were going down. It just meant they weren't going up as much as gold was, okay? But that started to change. And early this year, silver started to really ramp on the upside. It's a signal we put out to our subscribers based on other technicals. And the performance upticked. And on the November close of the spread versus silver versus gold, you also had a breakout of a multi-year base. So not only did gold say, hey, I'm on top of the game versus the stock market, silver said, now I'm going to outpace you, mama metal. Silver is coming up from depths. And its depths are pretty deep, meaning you got down as low as 1%. Divide an ounce of silver to an ounce of gold. And if you go back 50 years, that's low. It's been there before, but that's it. That's the low, okay? And we've now since surged, and it's broken out as of November. Now, back in November, where did silver actually close in price? $56. Okay, 2 weeks and a day into the new month, we're $64. Wow. Okay, something happened, and it wasn't just that silver was going up. It's been going up for a couple of years, like gold, right? Okay, but the spread broke out, and once that spread broke out, it told us if you're going to go into monetary metals, emphasize silver and silver miners. Doesn't mean the gold miners are no good or gold's no good. It just means silver and the silver miners, which have been languishing and vastly undervalued compared to their peers, are now ascending, and they're going to be on the top. And that's what's happening. And we think silver at minimum is going to at least reach 2% very quickly of the price of gold, meaning from where it was at the lows back like in April, it's going to double in value relative to gold. Not double in price, double in value. So, and the gold's going to be going up during that time. It has been. But silver's going to outpace it. Now, there's another chart that might help you in that regard. Flip the page, one more here. No, another one. There you go. This is gold going back to when it was legalized. At $200, it dropped down to 100 back in 1976. And then from that 76 low to the 1980 high, that's the first up arrow in the horizontal. That's an 8-fold gain. This is a ratio chart, logarithmic scale. It's not a point scale. Okay. Then you made a low in 2001 and 2, or 2001 I think it was exactly, $265 or so. And you had another major surge over a lengthier period of time, but the same dimension move, an 8-fold gain up to the 2011 high. And then you had the pullback to 1,050 on gold, and then you labored for a couple of years, and finally you took that out in 2020. And you're now at where? 4,000 plus. Well, the bear low was 1,050. We're only 4-fold gain in this bull trend. So the people who say, hey, gold's overdone. Well, it isn't even matched. It's only halfway the dimensionality, percent gain that we saw in 1980 and then we saw a 2011 peak. So if we merely match those two prior bull markets, gold would be like 8,500 or something. Now, we're not projecting that as a target. We're just simply making a point that people who think gold is overvalued don't realize that on a percent gain basis, no, it's not. And we certainly have technicals and fundamentals that are far more potent this time around than were in play back in 1980 or 2011. I frankly think we're going to go way past 8,000, and probably in the next year or so. In other words, you factor in M2 growth, how much quantity of money has been created, printed, over from 1980 to 2011 or 2011 to the present. Silver would probably be, $500 just to match those highs in terms of decay in the money unit. But anyway, this chart is broken out, but if you just take a simple measurement, and again, this is an idiot rectangular measurement. The lows were like $4 or $5, the range, that 50-year range, and the highs were 50. So let's call it $45. So we're talking about, we're going to go up to, on an arithmetic scale, you go up to 100, but on a ratio scale, that's a 10-fold dimension rectangle. You broke out at 50, that says you go to 500 to match the depth, the thickness of that range that you just broke out of. We think silver is going to do something extremely dramatic, and it's going to do it in the next handful of months. Why? Not just because this breakout has occurred, but we've studied many other markets that have done similar things. I'll give you an example. Copper, back in from 1970, 80, 90, 2000, up through about 2005. So for multiple decades, lived in a price range at a very low level, like either side of $1.50, okay? Up and down, up, just like this range here. But it was about 30, 40 years wide. But at a very low level. And when it broke out of it in late 2005, early 2006, it quadrupled in price in a matter of 2 or so quarters. 2 quarters, you quadruple price up to 450. Yeah, you had a sell-off after that, but they've lived in a range now. We're starting to emerge above that recently. That is 4 times the average price of that range that existed back in 1970, 80, 90, 2005. You cut through the middle of that range, you've lived in a range 4 times the price level of that. But the shift to the new reality was so fast, took your breath away. Then we also found a chart of lead, exciting metal, right? Lead, okay. Same story, it lived in a range, 70s, 80s, 90s, 2000. In 2007, different from copper, year and a half after copper made its surge, lead broke out of a similar dormant range, and it quadrupled in price in a matter of a couple quarters and lived in a new reality since. How come silver's been caught in this box for 50 years, whereas lead and copper zoomed 4-fold out of a range that was okay? Well, there's arguments that are valid that it's been artificially contained by government efforts, banks in coordination with the central bank trying to keep it restrained. Whatever the excuse, it's been restrained. And quite often, as we know in market history, when a market does something in excess one way and corrects for it, it quite often overcorrects, and it does it quickly. This is why sometimes stock markets crash, okay? Similarly, when a market is depressed for too long and made a mistake, so to speak, not all markets are rational, remember, okay? That's a false assumption. Then it goes to a new reality, and often it'll overshoot where that reality might ultimately, on average, be, like the copper move to 450. After that, it dropped back and lived below that level for quite a while. In silver's case, where's the tantrum going to take us? And we also have another indicator that says we're going to rampage, and that's this. In that 79 to 80 surge, that first ellipse you see on that chart, silver went from like $8, $9 to 50 in 2 quarters, okay? Still within the range, but it went up, under 10 to 50 in a matter of a couple quarters. It had already been going up for a couple years, so it wasn't like, oh, it just started a bull market. No, it was in the bull market already, but the spread of silver versus gold broke out, and it signaled that silver's going to go on a rampage, not only on a net price, but versus gold, and it did. Same thing in 2010 and 11. You'd been going up for years, and in September 2010, at a price of about in the 20s, you went up to 50 in a matter of 5-6 months. You doubled in price, boom, just like that, a couple quarters. This time, we're not only going to surge, but we're breaking out of this range as well. So a lot of power is going to be unleashed here, and I think a lot of it will be compressed between now and sometime in the second quarter.
So, Michael, is it fair to say that the next phase in this precious bull market might just be an acceleratory phase where we go significantly quicker, significantly higher, significantly faster?
Yeah, I think we will, and I think other factors will come into play. Other asset categories will help assist in the shift, like we just saw in the stock market spreads versus gold. Something happened there. There's already money moving. Every day they talk about, oh, new high in the S&P. Well, it's like, nudging like a snail on a chart, and whereas gold's surging. And only recently have the financial news networks even talked about gold. And usually when they talk about it, they say, oh, it's excessive. Instead of cheering the new high, they, oh no, it's excessive. Meaning don't buy it. Okay, fine, I like that. I want people to stay out as long as they can, because when they come in, you get the rush. Okay, but as gold goes up, and it won't be as dramatic as silver, no, percent-wise. Silver's the one that has the dues to pay on the upside, meaning a new reality to go to after being suppressed for half a century. And our minimum target, my own personal positions, which I reveal at the end of each of our reports, is that we'll probably see $200 by the second quarter. Now, I could be wrong. We might vastly overshoot and see something even higher than that. Seriously. So I'm open to that possibility. So I do not have a precise target. I have a ballpark target. And I think the minimum end of that is about 200. Now, there will be a jiggle in the middle. fact, in the 79 to 80 surge and the 2010 to 11 phase, there was a jiggle in the middle where about 3 months into the move, you had what looked like a reversal month. And it looked like, oh my gosh, that's it. And it wasn't. It was a fake out. And then you tacked on another 3 months. So I'm fully expecting that in the next 6 months, while we go up massively, there will be a point probably somewhere in the middle of that. And it'll be interesting where that occurs. Because if that occurs well over 100, then it's telling me, yeah, the 200 is likely. Now, if that occurs only at $80, 2-3 months from now, we only crawl another 10 or 15 bucks, then maybe we'll have a less subdued high. But my suspicion is by the end of the next couple of months, remember, this is month 1 now in the breakout. You broke out in November, so December is the first month. So I'm counting 2 quarters from there. Anyway, I think that likely we'll see at least 200. And I think silver, if you go back in history, silver ratio to gold, or not the ratio, but the percent scale, in 1979-80, silver reached 6.5% of the price of gold at the top monthly close. And the peak monthly close back then, we touched 50, but the close was like 38 or 39. So at that peak monthly close, silver was 6.5% the price of gold. Okay. In 2011, it was 3.5% of the price of gold. Okay, right now we're trading around 1.5% the price of gold. Meaning if you go to even 3.5%, match the 2011 relative performance level. That's more than a doubling of silver relative to gold from where we are right now. And the other assumption I've got is if the price chart has been caught in a range for 50 years, why should we assume that the spread relationship between silver and gold has to stay below the highs it saw in the last 50 years? 6.5%, 3.5%. What if we take out both of those as well? Woohoo, you do the math. Anyway, something big is happening here. Focus should be on silver.
I think you've just answered this question, Michael, but for anyone looking to add to their silver or gold positions, is it time to chase or should one wait for a pullback?
Yeah, actually, the entry points that we've given over the years are far below current levels. Okay, the last major entry point we offered on silver was as it approached $35 from the underside in June. Okay, it's since almost doubled. Okay, that was a momentum-based signal, and of course, silver blew a cork after that. Shot up to the well, it's still blowing the cork. Okay. But from the point of view of this chart here, taking out the price range, but also the spread relationship to gold, breaking out as of November, also the monetary metals, silver also broke out versus the S&P, by the way. So all those metrics are saying, hey, something just began. So in answer to your question, if you're not in the monetary metals, yeah, it looks late on the chart, but actually there's signals that are being rendered here that are saying, no, the big game's really just beginning. So if you get in now, you're not getting in too late. Yeah, it'd been better to get long silver at 20 bucks or 30 or whatever, but this is an entry point, probably the last one you're going to get. Okay. So yeah, it's a good question, and I think this is a fair and good place to be entering if you're not already in.
Perhaps we can also quickly talk about miners for a second. Should we expect them to follow precious metals, or is there a chance for them to decouple and perhaps lead the charge?
Scroll another page. Okay, now here. This is the XAU index, which goes back to the 1980s. GDX is the popular ETF for gold miners right now, but it only goes back to 2006. XAU goes all the way back to the 1980s. It's a gold and silver miners ETF, Philadelphia Exchange. It lived in this is dividing XAU price into an ounce of gold. And you can see from the 1980s, 90s into 2008, it lived in that red range, meaning the lowest it got versus gold was about 17.5% of the price of an ounce of gold. The highest it got was like 35%. And it lived in this range for multiple decades. And then in September of 2008, actually 1 month before they really collapsed the mining sector, you broke below the bottom of that spread ratio, spread box there. So you blew out the bottom. That was a sell signal, in effect, saying no longer are the gold miners going to be on par performance to gold. They're going to underperform. And boy, did they. Because the spread relationship dropped from like 17% all the way down to 4% by 2015. I mean, what are you going to do? Go to zero? Okay, no, of course not. But the miners have been vastly undervalued for 11 years now, that green rectangle. That range is like just above 8%, like 8.5% was the highest reading in that range, and the low was 4% back in 2015. We're now surging up toward the top of that range on the spread. If the miners can break out over the top of that green rectangle, meaning divide XAU into gold and find that on a given monthly close, XAU is more than 8.5% of the price of gold, expect it to surge massively. Now, even if you just go up to resistance, and you can see where resistance is, it's the old lows, up at that 17.5% level. Well, heck, that's a doubling. You know, you get a breakout above 8.5, that's doubling to get to 17. So that means the miners could double in relative value to gold just getting up to that red line. So what this spread chart is telling us is that not only is gold shifting versus the stock market, and silver and the miners are breaking out versus the stock market, but relative to gold itself, the miners are, we know they're cheap. Everybody talks about how cheap they are relative to their intrinsic value. They're waking up. And if they go through the top of that range, expect a gusher on the upside in terms of net price for the miners and two, relative gain versus gold, likely to be at least double. Now, I'm not going to predict how long that takes, but I would guess a year or so. So if you're in the mining, if you're in the gold monetary metals sector, emphasis should be on silver and miners, not Mama Gold. Mama Gold's going to keep going up, but the little guys are going to pass it now in terms of performance. So this is a chart to really watch here.
If I understand you correctly, Michael, what you're saying is that these miners have the potential to double in relative value to gold, while gold could potentially continue higher.
Yeah, sure. It means even double in relation to gold, but gold's going to be going up while they go up too. It's just like when it broke down in 2008 through 15, especially through 2011, 12, and 13, 14, 15, the last 4 years of that decline, gold was also going down. So not only were they collapsing in price, but they were collapsing in relative value, so it was even worse for the miners. This is the opposite situation now. So a lot of people now who are fearful that the gold miners will go down with the stock market, we're in a totally opposite position that we were in 2008. 2008, at that red circle and that black arrow in the middle of the chart, you broke down prior to that October crash in the stock market. Also a month where the miners broke down. And after that, the miners languished relative to gold. Yeah, they made a new high in 2011 in price, but it was nominal, where gold doubled during that time. But now they're in an opposite technical position. Scroll to the next page. I think there's a chart there too. No, okay, let's go one more. Yeah, this one. This is the gold mining sector, XAU, gold and silver miners index. Going back to 2013, again, when gold was collapsing, so were the miners relative to the S&P. They were losing value to the S&P. So the spread was collapsing. They made a low near 2% back in 2015. That's actually when XAU index made its lowest price. And then you had a couple surges in performance in the gold miners relative to the S&P. Those also were surges in XAU price as well. Again, you have a line like you have on the gold chart, where for 11 years you have this very precise line that you hit 1, 2, 3, 4 times in this case. You blew through it in November. In other words, the gold miners are now saying, hey, I'm not going to be weaker than the S&P. I'm going to be stronger. Which also tells us that probably there's already money beginning to leave the stock market. Even though it's not going down, it's certainly not much going up either for 3 months. It's going somewhere else. And we know the gold miners have been exploding. And given the tininess of that sector, it doesn't take a lot of money moving from a decaying asset category like the stock market and moving into the miners to take these guys off the page. So this is another argument that miners are a place to be, and don't be haunted by that event in 2008. The conditions now are opposite the conditions, the technical conditions in 2008 relative to the miners.
So I guess a very similar question for miners would be, this is also a time to potentially chase them if you want a position.
Yes, I think yes, it is. It's you're chasing when you look at a chart going back a couple of years. GDX, for example, the popular gold, and it's got some silver miners in it. ETF took out the 2011 high just recently, and it's living on top of it. It's quite firm, but it just broke out over those highs. Well, this spread, the same is true with GDX, by the way. We could plot GDX versus S&P and get the same picture you see here. So it's a fresh asset class signal shift saying buy miners, sell S&P. Or if you prefer one or the other, just go to the miners, leave the S&P alone. I suspect this spread's going to explode, just like the XAU versus gold spread is likely to explode, meaning full fuel in the tanks for the gold miners. They're a vastly undervalued stock market category.
All right. Are there any other commodities that are currently, or asset classes for that matter, that are currently on your radar, Michael?
A long-term investment point of view, not the dynamite move that we think we're about to see in gold and silver, especially silver in the miners. The broad commodity complex collapsed from that first major surge high, which MSA did call. At about 70, we said Bloomberg's going to explode. It went to 140 within a year and a half, so it doubled. Still very cheap. Bloomberg at 140 in 2022, just before that war commenced, was half the price it was in 2008. So commodities weren't really expensive even there. Then they pull back 2022, 23, 24 to either side of 100 on the Bloomberg. Now, Bloomberg is well balanced. It's got oil sector, grains, sugar, base metals, and gold and silver are mixed in there as well. That basing pattern we've seen on price, Momentum said October's close, just above 106.50. Get long again, I'm waking up, I'm going to make another move. Okay. It's now, since then, it's gone up to 112. Right now we're trading, I think, with 109, 110. It's very quiet. Oil still is a weak component, which I think was going to surprise people because it's got technicals that say it could explode up out of here probably in the first quarter. But I think in general, from an investment point of view, the commodity-related stocks, such as oil-related, grain-related, fertilizer companies, ETFs like MOO, which is the agriculture-related ETF of companies in the ag business, or ETFs of oil-related companies, it's base metal mining ETFs, are a good place to be probably over the next handful of years, because they have a similar situation spread, Bloomberg commodity versus the S&P. They collapsed. The spread looks like a massive base with nothing but thin air above it to rally. And it's pushing up toward breakout levels, on a relative basis I'm talking. So it looks like an asset class shift there is about to occur as well, meaning favoring commodities, disfavoring the paper bubble market. And I think that's a place to look very hard if you're an investor. No leverage involved, just find stocks you like in those sectors. And we analyze them constantly, looking for better places to be. But I think that's going to be a good place to be for the next couple of years.
Incredibly interesting, Michael. Perhaps you can quickly talk about Momentum Structural Analysis.
Well, we analyze all four major asset categories: debt markets, foreign exchange, commodities, especially gold, silver, and the stock markets, including not just U.S. markets. You have to look at all these tectonic plates because they're bumping into each other. You don't just look at gold and silver. That's no good. Anyway, and we put out a major weekend report and usually 2 or 3 reports during the week on various of those categories. Been around since 1992, so we've been around a while. We have a unique, unorthodox methodology of analysis. Go to our site, Oliver MSA, tool around for a while, look at what our method is, and so forth. And if you want some samples, request them.
Oliver MSA, link will also be in the description. I know you need to run, Michael. Thank you so much for your time and your insights today. I really appreciate it.
Thank you very much.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CDAR Plus at www.cdarplus.ca.